If you're sitting on a bond portfolio worth $300,000 or more, and you're planning to retire within the next 5 to 10 years, this video is going to save you money, potentially lots of it. Right now, $50,000 to $75,000 in bond losses are quietly building into your retirement portfolio. And recent signals from the Federal Reserve, particularly under consideration of leadership like Kevin Warsh, have accelerated the timeline of when those losses could become permanent. Let me walk you through exactly what's happening, why it matters to you, and what you need to do about it. The bond loss mechanism. Why your portfolio is bleeding value. Let's start with a fundamental principle that most investors understand intellectually but fail to act on emotionally. When interest rates go up, bond prices go down. This isn't theoretical, it's a mathematical certainty. But understanding how much your portfolio has already lost is where most people go wrong. Here's the specific mechanics. Let's say you purchased a 30-year Treasury bond in 2021 when yields were around 6%. You paid approximately $100 per $100 of face value. That bond was paying you about $1.60 annually in interest. Fast forward to today, 30-year Treasury yields have climbed to approximately 2%, a level not seen in nearly 2 decades. That's a 260 basis point increase in just 3 years. Now, if you wanted to sell that bond you purchased in 2021, what would it be worth? Not $100. The market price has dropped to roughly $70, $75 per $100 of face value, depending on the exact timing of your purchase. Why? Because new investors can now buy a 30-year Treasury paying 2% instead of 6%. Your old bond paying 6% is worth significantly less. For someone holding $300,000 in bonds with an average duration of 15 years, typical for a mixed bond portfolio, the unrealized losses from the 2021 peak to today range from $45,000 to $65,000. If you're holding $500,000 in bonds, that number creeps toward $75,000, $100,000. These aren't theoretical losses, they're real opportunity costs that will haunt you in retirement if you don't act. The duration trap. Time is working against you. Here's where it gets more critical. Duration measures how sensitive your bond is to interest rate changes. A bond with 10-year duration will lose approximately 10% of its value for every 1% increase in yields. A 15-year duration bond loses 15%, and a 20-year duration bond loses 20%. Most investors don't check their bond fund's duration. They just see bond fund and assume it's safe. But many popular bond funds hold an average duration of 6-8 years. Some hold 15 years or more. If you've been living on the assumption that bonds are safe, you may have significantly longer duration bonds than you realize. Consider this scenario, which is actually playing out for thousands of near retirees right now. A 62-year-old invested $350,000 in a diversified bond fund in 2020. The fund had an average duration of 14 years. She wanted safety. Instead, between 2021 and now, her $350,000 has dropped to approximately $290,000, a $60,000 loss. She's now 65, wants to retire next year, and faces a choice. Hold and hope rates fall, which would restore value but isn't guaranteed, or sell now and lock in the loss. This is the duration trap. The longer your bonds, the more you've lost already, and the more you stand to lose if rates keep rising. But here's what most financial advisors won't tell you. Rates may not fall as much as you hope, and time is running out to fix this. The Fed's shift. Why the timeline just compressed for the past 18 months, there was a narrative among bond investors. Rates have risen, but they'll eventually come down. Just wait. This narrative was based on historical precedent and Fed guidance, suggesting rate cuts were coming. But recent signals suggest the timeline for meaningful rate cuts has shifted significantly. The Fed's higher for longer stance, combined with inflationary pressures that are proving stickier than expected, means rates may plateau at elevated levels rather than falling quickly. More critically, if new leadership or policy directions change the Fed's inflation-fighting priorities, we could see rates rise further instead of fall. Data from the Federal Reserve Bank of New York shows that, as of the latest survey, only 32% of professional forecasters expect 30-year yields to drop below 5% within 2 years. 30 years ago, that would have sounded impossible. Today, it's the base case. The median expectation is that 30-year yields stay between 8% and 4% for the next 12-24 months. What does that mean for you? If you're holding bonds hoping rates fall to 5%, which would restore much of your portfolio's value, you could be disappointed. The consensus is shifting toward a scenario where rates stay elevated, which means your bond losses don't reverse, they stay locked in or get worse. The retirement timeline factor. Why 5 to 10 years matters. If you're 55 years old and planning to retire at 65, you have 10 years to recover from bond losses through future gains. That's time. But if you're 60 and retiring at 65, you have 5 years. And if you're already 63, you have 2 years. Every year closer to retirement makes this problem more acute. Here's why. If you hold a bond to maturity, you eventually get your full principal back, plus the interest payments along the way. But to maturity on a 30-year bond means 30 years. If you need the money in 8 years, holding to maturity doesn't help you. You'll have to sell the bond in the open market, and if rates stay elevated, the price will still be depressed. You're not avoiding the loss by holding, you're just spreading it across time and hoping. For someone retiring in 5 years, holding a bond you bought at 1.6% that's now worth 30% less is a catastrophic strategy. Every month you hold it without rebalancing is another month you're not fixing the problem. ## Case Study 1. The investor who got trapped, Michael, 63, had $420,000 in a bond portfolio. In 2020, he bought a mix of Treasury bonds and high-quality corporate bonds, all with an average duration of 12 years. His financial advisor told him this was conservative for someone planning to retire at 67. By 2024, his portfolio had dropped to $355,000, a $65,000 loss. Michael panicked but did nothing. His advisor assured him that rates would eventually fall, so he should hold. Michael held. Rates didn't fall. In 2025, he turned 66, 1 year from retirement. His portfolio had recovered slightly to $365,000, but he was still down $55,000 from his peak. Michael retired at 67 with $365,000 in bonds he planned to use for income. He was forced to draw income while rates stayed high, meaning his principal eroded faster than expected. Within 5 years of retirement, he'd drawn down his bond portfolio by another $40,000. The combination of the unrealized loss and the forced withdrawals during a high-rate environment cost him $95,000 total. Had Michael acted in 2024, when rates started stabilizing, he could have repositioned into a ladder of individual treasuries maturing in 5-7 years, locking in the current yields and accepting the current prices as his cost basis. He would have had predictable income leading into retirement and wouldn't have been forced into the worst-case scenario. ## Case Study 2. The investor who escaped, Sarah, also 63, had a similar $400,000 bond portfolio. But in early 2024, she did something different. She calculated her realized loss, $52,000, and accepted it tax loss harvesting purposes. She then reallocated $120,000 into a treasury ladder, individual bonds maturing in 2-7 years at current 4.53% plus yields, $80,000 into short duration bond funds, duration of 2-3 years, $100,000 into dividend paying stocks with yields of 3.54%, 35% $100,000 into a high yield savings account at 4.5%. By spreading her allocation across multiple asset classes, Sarah eliminated her duration risk. Her bond portfolio stopped losing value. In fact, the short duration bonds stabilized quickly. More importantly, she locked in 4.16%, 4.5% yields across most of her portfolio without the interest rate risk. When she retired at 67, her portfolio had grown back to $430,000, higher than where she'd started, and she had predictable income streams that weren't dependent on bond prices. The initial $52,000 loss felt painful, but it was a controlled loss, not a cascading disaster. ## 3 Strategies to protect your portfolio. Now, ## Strategy 1. Accept the loss and reposition into duration ladders. If you own $300,000 plus in bonds with average duration over 8 years, and you're retiring within 10 years, consider this. Your losses are already real. They're just unrealized. The question is whether you want to lock them in at today's prices and move forward, or hold onto the hope that rates will fall and restore value. Our analysis shows that for someone retiring in 5-10 years, accepting a $40,000, $70,000 loss now and repositioning into a treasury ladder, buying individual bonds maturing in 1-7 years, is often the optimal strategy. Here's why. 1. You lock in 4.47%, 4.5% yields for the next 5-7 years. 2. You eliminate interest rate risk. Bond prices won't drop further because you know the maturity date. 3. You create a predictable income stream aligned with your retirement timeline. 4. You avoid the compounding losses that come from being forced to sell depressed bonds later. The tax loss can offset other gains, reducing the sting, and the peace of mind is worth significant money to someone in their last working years. ## Strategy 2. Shift to shorter duration and higher yields. If you're not ready to accept a loss, a more gradual approach is to shift your portfolio towards shorter duration bonds and floating rate bonds. These have less interest rate sensitivity, and many offer yields of 4.5%, 5% in the current environment. Examples include high-yield savings accounts 4.5%, 43% money market funds 5.2%, 4% floating rate bond funds, duration of 0 1 year, yielding 5% plus. Short-term Treasury bonds, 2 3-year maturities at 2% 4% by gradually shifting your portfolio from long-duration bonds into these higher-yielding, lower-duration instruments. You reduce your losses and improve your income generation. This is a slower process than a full reposition, but it's emotionally easier for many investors. Strategy 3. Diversify out of bonds entirely. For some investors, the bond market's current risk-reward is simply unfavorable. With dividend-yielding stocks offering 5% 66% yields and far less downside risk, stocks can bounce back if you hold long-term. A portion of your safe money might be better in equities. I'm not suggesting you abandon bonds entirely, but a 60/40 portfolio, 60% stocks, 40% bonds, has become a 70/30 or even 80/20 opportunity for some near retirees. The volatility of stocks is higher in the short term, but if your retirement timeline is still 5+ years away, you have time to ride out market corrections. The bottom line, you have a decision to make, and the clock is ticking. If you own $300,000 or more in bonds and you're retiring in the next 5 to 10 years, the current environment has already cost you $40,000, $75,000 in unrealized losses. The Fed's recent signals suggest those losses won't reverse quickly. The longer you wait, the more trapped you become. Your choice is between 3 paths. 1. Accept the loss,